Right, hi all. So we're a couple of minutes over now, so hopefully we'll have a few more people join, but we've got quite a few already. So good set of participants here. So thank you very much for joining this webinar here with Black Diamond Advisory. So you have myself and Vincent. I'll introduce us a little bit more in a second, but we're going to be here talking about strategic finance. So um, what it is, why does it matter, and showing how we can solve that within OneStream. So I'm your host. My name is Daniel Hopson. So I'm the Global Technical Director here at Black Diamond Advisory. So my role here at the organization is doing things like hosting some of these technical webinars, but also looking after our organization from an overall technical governance and architecture perspective. So what are we here to talk about? Strategic finance. So this is really how we approach strategic finance within OneStream. So basically making sure that it's scalable. You've got the data quality going through with OneStream and making sure we're keeping all of that in line. And then, bringing in the operational finance to enrich that, the operational information to enrich that financial data and help you make those decisions that you'll need to kind of stack up your strategic finance. So why are we talking about this at the moment? Well, we've been implementing OneStream for a long time. We work with a lot of CFOs and heads of the organization, and we're seeing the kind of questions that we're getting and the messaging changing over time. So there are a number of priorities that finance and operations teams are balancing, and we're seeing those being reshuffled there. So there's a couple of stats on the screen. I won't read them all out to you because I'm assuming everyone can see my screen. I hope so. But we're seeing things like 46% of finance leaders now are really focusing on managing their position, especially with fluctuations of interest rates that we've seen, heavily going up and hopefully coming down, obviously, in the future, well, for most of us. And a number of respondents there, 32% at the moment, are really looking at considering the inflation as a significant risk to their organization, which is obviously understandable. And one of the key things that the strategic finance model, as you start to bring that into your organization, you can really start to look at and tap into and understand some of the positions there with scenario analysis and so on. You know, everyone is looking at working capital these days. Really starting to look at how you optimize it and so on. And CFOs are really kind of starting to focus on those core initiatives to the organization to see how they stack up, and you measure them and align those initiatives to your financial plans as well. So why should you trust BDA? Why are you on this webinar? Why should you listen to these kind of things and listen to us actually talking about this? And one of the first reasons I would say is that we have some fantastic people here at BDA, but that's very easy for any organization to say that they've got good people. So how do you back that up? Well, in the instance of planning, of which strategic finance is a lot of the time, we wrote the book on it. So there is a OneStream planning book. Why you do it, how you do it, when you do it. There's a lot of good functional and technical content within there. Everything from how do I load data to how do I run consolidations, how do I run data buffers, and all of that wonderful technical stuff. But BDA are the people that wrote that book, and OneStream published it. So we've got two fantastic people here at BDA, Cameron Lakpour and Sylvan Katukaran. They're in our product team, and they really push some of the innovation that we start to drive as an organization. So, going back to that question about why should you trust us and why should you listen to this? I mean, we wrote the book on it, so hopefully we know what we're talking about. Vincent, who we're going to kind of drop over to in a second, he's the main person here driving these strategic financial initiatives at BDA. He's going to be the one that takes you through the demo. So at this point, I'm pretty much going to hand over to him, let him introduce himself, take you through some of the challenges that he sees, that we're solving for within OneStream, and really then take you into a solutions demo to show you how we are delivering this at BDA to help assist organizations with their strategic planning. So Vincent, at this point, I'm going to let you introduce yourself and talk about what strategic finance is and why it's important.
Thank you, Daniel. Yeah, that's a fantastic introduction, and just kind of to re-emphasize the whole team aspect of this. Daniel mentioned I'm leading the initiative here, but behind me is a team of people who've been working hard on this, and we're actually delivering this model that you're about to see at a client of ours at this present time. So you're seeing real world. You're not seeing a mocked up demo. It is real world, and it is a real model, and we're going to show you all that today. Before I show you the actual model, though, I do want to cover some basic stuff about the model, so you understand what is it that you're going to see here. And what you're going to see is three things. I'll be kind of circling back to these three things afterwards as well, to make sure that you've kind of heard me and heard me again. And those three things are that this model represents fully integrated business planning. All too often, organizations have a very long FP&A process. Maybe they implement OneStream and they can get themselves to a shorter, quicker FP&A process. They obviously have or should be using OneStream for their consolidation. That kind of makes sense, but that's not the full cycle, the full suite. This is the last piece. This is the strategic planning suite of that piece, or the strategic planning aspect of that suite, of that circle rather. And this model represents that. This is that pillar essentially in there. And we basically are going to use this model to be able to inform the FP&A cycle. So that's the goal here, is that this model is a set of numbers, their own cost of numbers, that is going to allow you to be able to prepare targets in advance of the FP&A cycle. And that's point number one. So fully integrated business planning. You'll see also in point number one that we will start off with the budget as set for last year. Now that could be the budget or that could be the forecast. In this case for 2024, it could be any forecast or any budget. And so that's what we mean by fully integrated. We bring the budget in that was already set and we're setting new targets going forward. The other important thing about the solution is scenarios, scenarios, scenarios. And that is that we've built the solution to have up to 100 scenarios and still be performant. The solution can and will handle any number of scenarios you possibly need. And you'll be able to look at all the same numbers through the different lenses of the different scenarios. And I'll be demonstrating that today as well. We don't think that anybody will ever use 100 scenarios at the same time. But we built it so that it can. So we didn't want to pick a number like 5 or 10, and then someone says, well, I need 11, and the solution doesn't work. So we built it robust enough to handle up to 100 scenarios. The last point you'll see is Excel is great, but I think having been doing this kind of work for, I don't know, 8+ years now, that the simplest solution should prevail. And every company we walk into, their solution is 30 tabs in Excel. And it's definitely not simple. It's a solution that is formula driven. They have a specialist who only knows how the Excel works. And without that Excel, they can't even do, sometimes up to just one scenario. They'll be lucky if they can do 3 or 4 at the same time. So those are the 3 concepts that I hope to see, that I hope to demonstrate to you and you hope to see in this solution whilst I show you the actual content itself. So I'm not going to just show you these 3 things, like I said. These are the themes that I want to cover as I show you the solution itself. Without further ado, I'm going to get right into the demo.
So Vincent, while you're just stacking the demo up, and I'll stop sharing my screen, what I would just say to everyone attending and watching as Vincent's presenting is please feel free to put questions, comments, everything into the chat. I'm very good at interrupting Vincent, so we'll try and interrupt him as he's doing his demo, see if we can throw him off track. And if not, we can ask more questions at the end.
Fantastic. Thanks very much. All right, so I'm going to start with the end in mind, and this is it right here. This is the report by scenario of your financial statements and some key metrics on your financial statements. And you can see here, I just picked out a couple: sales, gross profit, SG&A, EBITDA, current year dividends, current ratio, interest ratio, debt to equity ratio, sorry. And I've got my 3 scenarios: high, base, high, and low, and across my 5-year period. 2024 represents my budget that I just finished. And on the left side here, I've got my different divisions that I'm doing this work at. And so I've got the consolidated position for my whole group. And then I've got a manufacturing division, a retail division, a logistics division, and a banking division. I didn't want to pick any given industry and only focus on one industry. And then someone says, well, that doesn't really help for my business. The point is the solution is multifaceted and can deal with any industry we need to throw at it. But there it is. There are the results of all the work that has gone into this plan. And now I'm going to walk you through the steps to get you to this plan. In addition to the results that you see there, we have a balance sheet, also by the different companies, an income statement, also by the different companies, and a cash flow statement, also by the different companies. And we can click on any one of these divisions and we can see their results as well. And we can click on any other scenarios and we can see the results of the different scenarios. Same with the income statement and same with the cash flow. Highlighted some key metrics at the top of the income statement, and then I have a very simple free cash flow statement. It didn't go all the way to the bottom of the line, but we can. So how did we get all of this into the screen and into this format, and how quickly can we get this together? I'm going to go over here and I'm going to show you the rest of the suite. We call this strategic planning suite because it really is a suite. I've been asked that question a couple of times. It really is this whole model, this whole package built to work together that you can then configure for your company and actually use at your company without a lot of work. And when I say without a lot of work, I mean weeks, not months. So we start off with just the simple scenario setup. We're talking about base, high, and low. You'll see I have another scenario here called likely. I might refer to that at a later point in this presentation. And you can see I just set this up last week. After I set up my scenarios, and I can give whatever descriptions I want, I can set up whatever scenarios I want. After I set up my scenarios, I can set up whatever currencies I want. This will deal with both in-statement translations, so a Canadian company holding US debt, or US company holding Canadian debt, and also the consolidated translations from the different divisions up to the consolidated level. Finally, I can set interest benchmarks. You heard Daniel speak about changing interest rates. So I can set some interest benchmarks, and then I can manage my debt against those floating rates if I need to. Go back to scenarios here. Once you've set all this stuff up, you can set up your FX assumptions against those different scenarios. So now you can have different exchange rates against different scenarios, and you can plan for what would happen to my balance sheet if all my foreign debt all of a sudden was devalued, for argument's sake. I can set up my interest assumptions for my floating rates against my different years. Go back to scenario setup, and that's it. Once you've set this up, the rest of the solution is plug and play. So we're going to go over to the income statement, and we're going to look at our manufacturing division and just focus in on just their income statement for now across the 3 scenarios. So the same 3 scenarios that we set up there are available here. Excuse me. And you can see I've introduced a level of detail here that most of your Excel spreadsheets probably don't even get at when you're trying to do strategic type planning. And in here, we've developed the standard BDA accordion methodology with regards to how we do driver-based forecasting. So you can see this is a drop-down. I can change this to the previous 2-year average, for example, which will just sum up the 2 years and divide it by 2 and produce that as my outcome. I hit save. First one's always a little slower. Just give it a second. There we go. Already done. And my entire plan to my bottom line here already recalculated. I can go ahead and put overrides in place. And that override's already considered. 4,600 plus 4,000 divided by 2 is 4,300. I can go ahead and inflate that number. You heard Daniel speak about inflation. What if the value of my currency changes? And all of a sudden my financial results don't mean the same thing in today's dollars as what they did before. And all of this is available all the way down here, including margin calculation. And you can see here, COGS is actually the balancing number. So I don't have to plan COGS. I can plan sales times margin, which is what I'm doing over here. And I can go 4,000, 40% fixed margin in that particular period is 1,600 margin, 2,400 COGS. Really straightforward. Buy my different products, gadgets, widgets, and gizmos. And then I can do the same with my operating expenses down the bottom here. I can go with the prior year average, for example, and I can say apply an inflation rate of 2%. And it's done. My plan for manufacturing at this level is done. Now, the obvious thing to note is it's yearly. It's very specifically annually. And that's because we're not trying to replace FP&A. We're trying to provide the targets for FP&A. We're trying to provide the scenarios that we want to provide to the banks. We're trying to stress test our model. We're trying to look at the macro indicators of our business and very quickly determine the direction of our company. And the whole reason we're trying to do that is because we want to see how will our company perform when exposed to these factors. Will it do better? Will it do worse? Can I do other things to respond to these stress factors? Do I need to make acquisitions? Do I need to save back and hold back on my cash expenditure? Maybe my capital expenditure is a little bit high. I need to tame that up a bit. Whatever it is that you need to be doing, you can be doing with this model, planning that out in advance. And then once you've got that, you can send that down to the FP&A process, and you can have an adjusted forecast mid-year, for argument's sake, that could respond to these changes appropriately and have your day-to-day forecasting drive out the activities that will get you your longer-term plan. Gone are the days where you only do a 5-year plan once a year in May, and that's it. And you hope that that's where you end up 5 years from now. And again, I can do this by the different scenarios. In fact, all of these scenarios have been calculated at the same time every single time. So all the changes I made on the previous sheet have already been calculated here as well. And I just click save and everything goes. And so I can have a higher sales, a higher margin, my high scenario. I could for argument's sake, have a much lower sales and margin on my low scenario. And as I mentioned, this is just the manufacturing division, but I can have this across my different divisions in my group. Moving then to working capital. You've heard Daniel mention the working capital question that CFOs have. Am I managing my working capital appropriately? Is my inventory on hand too long? Am I not recovering my sales quick enough? Same process. Now I can go ahead and plan my days sales outstanding. Hit save, and I can see my inventory and my accounts receivable balance change accordingly. My accounts payable, depending on obviously which one I changed. I just changed days sales, so obviously that'll be that. And again, you can see all the scenarios calculating at the same time, all the time. You see that spike there from 730 to 8 million, from 73 to 800,000, from 1.5 to 3.6. All at the click of a button. Really, really simple. Speaking to that third point, this model has to be simple. All my different divisions, including my consolidated group. Now we move on to something different, CapEx. Now we aren't talking about the capital planning that you do at the niche, at the project by project level. Here we're talking about kind of more global project planning. Now, it doesn't mean you can't plan for initial or individual projects. You can see here, I've got a new trucking fleet for the logistics division, or for example, a plant refurbishment at the manufacturing division, or a new showroom at the retail division. Doesn't mean you can't do that, but the goal of this is to be able to plan capital at a much higher, much more macro level. And in that, we're planning a new initiative, we're planning some sustaining capital, and we're planning some growth, just a little bit of growth. And this is for the consolidated group. So as I add new capital lines, some other capital, I can pick the entity that it's assigned to. I can go ahead and pick the date with the normal calendar selector. And just because it's an annual model doesn't mean I can't acquire the capital on the 2nd of June, 2025. I can determine when the cash flow date is. So the capital model that we have here actually has an earnings profile that you can associate it with. And so we're saying we're going to go spend money on the 2nd of June, 2025. And from the 2nd of July, 2025, there'll actually be EBITDA associated with that capital. And that'll happen then. And then we'll have an in-service date, which will basically also drive depreciation. So that might actually happen in June as well. And we can say that that's the end of June. I can pick the currency of that capital. So it doesn't matter what currency my division is. I can spend capital in different currencies as well, which again, as I mentioned up earlier, when you change your exchange rates, you can now see the impact on your plan of a massive capital outlay that you might be planning out in the future. Say $1 million, I can give it a useful life. I can give it a salvage value if I know that I can recover something from that capital at the end of its useful life. I can accelerate the first year's depreciation. If, for example, I know that I'm not going to retrieve or I'm going to lose a lot of value in that first year. I can also account for a tax cash allowance. Sometimes governments incent you for spending money in a particular area or particular jurisdiction, and they give you a tax advantage for that in that first year. So I can have that tax allowance. And then I can set my EBITDA multiple and my EBITDA target. My EBITDA multiple is really the EBITDA target multiplied by the EBITDA multiple will give me my revenue that I expect to achieve. So in order to produce an income statement, we need to start with revenue, and we determine revenue by saying 4,000 times 4, which will give us our 16 million revenue. And we know that our EBITDA will be 4,000, and the rest of our income statement fills in based on our normal history. These groups, group 1, 2, and 3, you'll see them throughout the application, and that's under this CapEx grouping here. What that does is allows you to do your own custom reporting. Every board package that presents capital to their board will always have the capital by some sort of classification, growth, sustainment, greenfield, brownfield, whatever it is that you want to create. You can create this drop down on this CapEx grouping sheet, and you have up to 3 different ways you can classify all this capital. And you can do the same with debt, you can do the same with equity, you can do the same with acquisitions, which we'll talk about in a second. And then finally, I can assign my capital to a different scenario or more than one scenario. And I can say that, well, that capital needs to show up in that scenario. And that's how simple it is. Plan capital. So we're going to follow the consolidated group's capital in the new initiative, the sustaining and the sum growth. And you'll notice in those 3, I've spent $20 million for my high scenario. I've spent $5 million for my low scenario. And in my medium or my base scenario, I've spent 10 million. And I've got some moderate EBITDA targets that follow each of those. But that's the capital model. Moving to equity investments. Equity investments work in much the same way, except here we're talking about acquiring a portion of a company. So you're not the only investor, but you need to plan for some sort of investment. And you go ahead and do that, and you can assign which group is going to participate in that investment. So who's going to lay out the capital for this particular investment? I'll go any day I want. And all of these dates actually mean something. They actually prorate the dollars at the end of the day. So you're not just picking dates for the sake of picking dates. You're actually prorating the impact of this thing, particularly in that first year. That first year could be 24, 25, 26, whatever the first year is. It doesn't really matter. And the goal with that is, whilst the plan is annual, we do want to be sensitive to the fact that interest isn't annual. And so, having $1 billion of new debt on your balance sheet at the end of the year doesn't mean you have no interest. You could have interest for the whole year if you acquired that debt on the 2nd of January. We set up the useful life or the duration of the investment in this case. Again, the currency of that investment, the amount that we're putting down, our ownership stake. Oops, not 40. It is our ownership stake. The earnings target that we're expecting from that, and any earnings growth over the investment period. I did that again. Any dividend targets, and any dividend growth. Again, a tax allowance is also an option. So if there's a tax benefit from investing in this group, I can plan for that as well. And then finally, we'll skip the groupings, assign it to a scenario. Save. It's that simple. As I'm making these changes, the financial statements are already updating in the background. So they're already there. You don't have to do anything. The financial statements are already done with all of these changes. Moving on to the next model, the debt model. Now I can go ahead and plan out known debt issuances. And so I'll just go through the example here. We've got debt, and I can name it whatever I want. So it can be the specific instrument name, or as you can see here, I've named it after a couple of banks. My principal amount of the debt, the currency that I want to borrow it in, the issuance date of the debt, the maturity date of the debt, and if I have a maturity payment. And so how this works is it gives you the ability to say, well, half of this principal will be repaid in full at the end of the loan. And so now I can set up a repayment profile for the rest of the debt, for the other 5 million. And so I can choose annually, monthly, quarterly, semi-annually. I can apply a fixed interest rate and say, well, this debt has 5% as a fixed interest. If it has a variable component, now I can assign that float, that interest rate that I established earlier on in the setup, and it'll automatically apply that as interest expense. I can also change my interest profile. Maybe I'm paying interest monthly, even though I'm only paying the debt semi-annually. I can also establish that the debt is intercompany. So what that does in this model is says, okay, the consolidated group has a lower cost of debt, but I really need to expand my logistics division. So I go borrow the money externally from the consolidated group. It pays external interest expense, etc. And I also want to see what the logistics division's balance sheet looks like internally to my group, to my company. So I go ahead and set up a second piece of debt that mirrors the first, and I mark it as intercompany with the consolidated group, obviously being owned by the logistics group. And OneStream, this model, will eliminate that debt on consolidation. I can also capitalize the interest. So if I'm borrowing debt specific to a capital program and I know I'm allowed to capitalize the interest associated with that, I can mark that up here. And instead of that interest expense being expensed, it will be part of my balance sheet, my total cost of my asset. The grouping, again, you can create the groups at your leisure. And then your scenarios, you can assign the scenarios to how the debt is going to be expended. Now, I'm not going to go and borrow the $10 million in my high and my low scenario in this case, and I am going to go borrow an extra 15 in my high and my low, whatever the argument is for that. That's what I do, and so on and so forth. Debt inputs are saved, and the financial statements are calculated. You can see that happening in the background. The second last, I guess, model before we get into the funding is acquisition planning. Now, every strategic plan always has some sort of bold acquisition strategy as to I'm going to acquire some company, I'm going to integrate maybe a competitor, whatever it is that I want to do. So we want to be able to plan for that. And I have shamelessly named our products that we offer at BDA as my acquisition targets. You can obviously name them whatever you want. And these names are free form, so you can change them to whatever you want. And the point of that is every one of these acquisitions are normally referred to in code very intentionally so that people don't spill the beans on who they're trying to acquire, maybe around the water cooler. We obviously want you to acquire a strategic planning suite. Don't forget that. Once we named our acquisitions, we can go ahead and determine when is it that we plan to acquire these different acquisitions. So obviously I can choose the acquisitions that I've named. I can choose the entity that's going to acquire them, and I can change the acquisition date by scenario. So same company, strategic planning suite. In my high scenario, I'm ready to go. Give it to me now. In my base scenario, I need a little bit more time to think about it. I hope that's not the case for anyone on this call. Quarterly rolling forecast, definitely want that. Machine learning, absolutely want that all the time. And I can basically modify how these financial statements come into my results, my main results, at whichever date we pick here. So it doesn't matter what date you pick. As you can see how you can pick the same entity and acquire it at 2 different dates as long as it's 2 different scenarios. And you can do multi-scenario selection as well. Obviously, one of the most important things for any good accountant is the PPA associated with that acquisition. And this is normally the information you have about your target. You roughly know what their assets are going to be. you have a good sense. Maybe you look at some external filings. Maybe you're already further down the due diligence process and you're already just kind of buttoning up an acquisition that you really are certain on, but you'll have this information. And so you go ahead and you fill in all this information here and you balance your PP&A, and you can see that in all cases, my PP&A is balanced. And this will represent my day one accounting. And you can see the scenarios at the top there are actually representative of the different targets. Finally, we do the subsequent accounting. And in the same way that we did the planning up higher in the income statement, we can go ahead and plan out the income statements for these targets that we're planning to acquire. So there's my day one accounting. That's my PPA. I can go ahead and say, well, over time, I would like to reduce my overall working capital as a consolidated group, and I want to show the impact through this acquisition. So there we go. I'm going to reduce my working capital in accounts receivable, and I'm going to reduce my inventory held. Maybe there's profit on inventory that no longer applies because I've acquired someone upstream or downstream from me. Go ahead and hit save, and that recalculates. Maybe I don't like the driver and I actually just want to hold it for a second. Go ahead and hold that. No problem. There's my new financial results. We do the same thing down the bottom here with my income statement. I don't know why one would acquire a company that you don't expect to grow. So we would expect a growth in sales. We would expect a slower or moderate growth in cost of sales so that our margin goes up. And we want to shrink OPEX at the same time. Maybe my plan's a little aggressive for a given scenario. And so I want to go ahead and reduce that there. Remember, these are by scenario as well. And so there are my financial statements that I expect to acquire this company for. And you'll see here, as I mentioned earlier, it doesn't matter when you're acquiring. So we're not calling out the years here. We're just saying that's day one, and that's the end of the same year. Whether day one is December 30th or whether day one is January 2nd, it doesn't matter. The system will automatically do the intervening accounting by prorating it accordingly with regards to the first year's results. But the point being is you can go ahead and plan out what the next 5 years look like. And so this year one could very well be the 4th year of your plan even. Doesn't matter. Finally, we get to the funding routine. And the funding routine is where this all comes together in the sense of you're planning out how your balance sheet's going to get balanced. How are we going to fund or pay for all of this stuff? Outside of the fixed debt that we've already determined, that we already know we're going to sign up, can we even afford what we're planning to buy? And in the same fashion, if we have too much cash on our balance sheet, maybe we've underutilized our cash or our available cash, can we account for that? Can we show that on our financial statements? And can we make that a reality? Now, this will be a two-part demo in this sense, because I'll be showing you the funding outputs here, the funding inputs here, and then I'll be switching back over to my financial statements in the reporting section and actually showing you those impacts. So on here, we're talking about a deficit order to begin with. If I have a deficit, I'm not going to go ahead and declare any dividends. That doesn't make any sense. And I'm also not going to declare any dividends in the low scenario. I also have cash. If I have a deficit, I'm going to utilize any of my cash up until my minimum balance of 0. I could change my minimum balance, and I'm in the consolidated group right now. I'll just change it to 50, just so we can see that. Long-term credit facility will be the first one that I tend to use. And you see it's a non-current facility, and it is revolving, which means it goes both directions. I can utilize it when I have a deficit, but I can also repay it when I have a surplus. Finally, I'm going to use my fixed instruments, and I'm going to go ahead and issue new fixed debt, both in the form of bank debt and in the other form of long-term fixed debt. And just very quickly, so that you understand why this weird-looking member script is here, is this talks about the configurability of the solution. This is why the solution works for you, because you don't have to worry about changing the model. This is why we say weeks, not months, because you can configure this solution to fit your chart of accounts. So we have all the mechanics in the background that I've been going through, and at the same time, you can configure the solution to fit your chart of accounts. You don't have to change anything in your chart of accounts. The solution goes in on top, you configure it for your chart of accounts, and you're off to the races. Maybe some development on the income statement if we need to. I'm going to go ahead and save this. That's done. We also have a surplus order. I kind of alluded to this earlier, but a surplus order would be if I have too much cash, what am I going to do with that cash? Well, like I said, I can't pay down this debt. It's fixed. I only want to pay down my variable or my revolving debt, and maybe I want to issue some dividends. And then if I'm done issuing dividends to my maximum of 200, then I'm going to go ahead and save up the rest of this as cash, also to a maximum. It doesn't help I have a balance sheet with a whole bunch of cash on it. We have a catch-all account called the funding surplus, which will be basically a trigger account to tell you your plan isn't balanced. You can't go ahead. Your balance sheet might be balanced, but your plan doesn't make any sense because you're just accumulating cash on your balance sheet. You really should be investing it in something. And so you can also associate interest and standby fees and the life of these particular instruments so that they don't stay there forever, as well as with all the other items, assign a scenario that these apply to. So let's go look at the outputs of this funding. I think we're doing good for time. And we're back to this, and we're going to go look at our balance sheet. And we see that our balance sheet is currently unbalanced. I don't know why it's unbalanced for actuals. That's a little miss there. Was changing stuff late last night, I guess. But in the forecast, we should see our balance sheet balanced based on the new funding routine. There it is. So it does recalculate the budget specifically because in the budget, interest rates might have changed. FX rates might have changed. So it is the budget seeded, but it does consider the funding routine in the budget year intentionally. I think it also does work acquisitions as well. And that can be changed. If you don't want that to work that way, it's a small setting. We can change that, no problem. And you can see your financial statements are now balanced. You can see in that particular period, my cash equivalents went back to that minimum of the 50 that I just typed in there. And in all the other periods, I went to the maximum of $1 million rather. And you can see there's that funding surplus that I was just talking about. I haven't spent enough money. And so I can also see my property, plant, and equipment. There's my 10 million from that base scenario that I just spoke about. And if I go to my high scenario, there's my 20 million. And there's another capital expenditure that I put in somewhere else as well. My low scenario, I'm down to the 5. I actually was supposed to be on the 5. We'll pretend that never happened. We'll go back to the high scenario and we'll play around with the high scenario a little bit. So in the high scenario, I don't have any surplus cash. And I have a deficit here at the end of the period. So I've spent too much money in my high scenario. And that could make sense. That extra 60 million, that extra 40 million that I spent over here, clearly I can't afford that. So if I was to say, okay, let's not take the amount that I've planned in capital, let's go ahead and take my own version of that plan. I'm going to ignore the plan that I set out over there and hard code that capital. In true BDA fashion, you can see the difference between a calculated number and a hard coded or a user input number. And we can now see that our balance sheet's unbalanced by $20 million. We run our funding routine and that should resolve. Done. There's our 40 million, there's our 60 million, and you can see our funding deficit is now down to 6. At the same time, we have our base scenario, still balanced, still with the 10s, no changes there, and still with the funding surplus. And in this case, I might want to spend more in capital. Go ahead and spend that. Unbalanced, hit calculate. And that's just for demonstration purposes only. This is actually embedded in the main solution. So you don't have to even hit the calculate button. And you can see there, I've used my surplus. And my balance sheet's balanced. I don't have a deficit, which means I haven't spent too much money. I have borrowed on my debt facility there and my credit facility there to make it happen within my maximums. I think my debt was a maximum of some number and so on and so forth. And that's it. And I can do this by division. And I can now produce my by scenario results. And if that's not enough to convince you that this works. You can even do this for all the scenarios. And so we'll go all the way back to step one. And we'll say, well, where's that likely scenario that I planned out just this week? I want that one instead. The low scenario just really isn't realistic. I'm going to go back to my reports. And I'm done. Hopefully you can see from that, very straightforward, very simple, very intuitive, not 30 tabs, a real suite, a solution that hangs together, easy to configure, put right into your app anytime. A short implementation lifecycle, weeks, not months. Scenarios, as many as you want. Many is probably 100, I guess. If you want 100, we'll put 100 in. Don't think you'll use them all, but they'll be there. Yeah, flexibility, and that's it. That's the end of the demo.
Thanks for that, Vincent. Great demo. Well, my opinion anyway. Hopefully everyone else's is the same. We do have a couple of questions that came in online. So the first one is, if you have a substantially higher number of brands or data that you want to manage during the strategic plan, how have we designed that so it doesn't impact performance, or do you not expect it to be built at that level of detail?
Yeah, so it's a balance. It's absolutely a balance. And at my assumption here, I've got 3 basic products, but that could just be 3 product lines or 4 product lines. So we absolutely don't want to cross the threshold of going too detailed, because then we're just trying to do FP&A at a very much higher level. And that's really not the point of this model. Because the next question you'll ask is, well, can I go to months? And I'll say no. So product lines, probably okay. And it doesn't impact performance anyway. So the way we write our code is for these items, and that's why I'm confident about scenarios as well. For both scenarios and products and anything like that that we write the code for, we're not worried about the size of the dimension. We're more worried about the user's capability of understanding and digesting what they're looking at.
Yeah, thank you. So there's one, I'll probably take the answer to this one actually. So as a OneStream customer, how do I go about purchasing the solution? So I'm going to assume someone liked the demo. And how long does it take to start using it? So what I would say, I'll take the first part of that. If you're interested in this, please just get in contact with us. You've got our emails now from the invite that went out. Go on our website. There's a number of elements on our website you can go and look at as well, white papers, demos, and so on. But specifically for this, please get in contact with our pre-sales team. They will put you in touch with the right people. There will be a light touch scoping exercise, and then effectively we move forwards into delivery, assuming you'd like to do so. Vincent, you mentioned there to take the second part of this question around weeks, not months. What does that look like from an implementation perspective?
Yeah, absolutely. So you all saw the income statement, and the income statement obviously is very company specific. Not every company has gadgets, widgets, and gizmos. Some would like to put, like the retail division might want to put, sales targets in there. Logistics division might want to put volume of some sorts. The banking division might have whole different things. So every company has something slightly different on the income statement side of it. And so depending on how big you want to make that portion, that could elongate the implementation timeline. But I really am serious. It's weeks, not months. I stood this demo up last week, and all these numbers are in here already. Now, it's not going to be 2 weeks. We obviously have to go through all the exercises like Daniel just mentioned, scoping, etc., make sure we understand your specific requirements. But the actual model, the suite, is already there, is already in place. Working out 1 or 2 bugs, I guess, to be honest, but it's there. And so we are talking about weeks, not months. We're not talking about a 6-month implementation. Any implementation, remember, I'm trying to beat Excel. So if the Excel model can be built in less time than this model, then we've lost, because then we will lose the attention of those in corp dev. We will lose the attention of the executive who wants a model that works now. So we're talking about weeks, not months.
Okay, excellent. Thank you. So another kind of getting to the bottom of some of the questions. If you do have any questions, please do put them in the QA section if you have any more or you're waiting to ask them. But one of the questions was around, you saw the income statement in this. So are we saying that we can only use the income statement and balance sheet that's been provided?
Yeah. So no, you can use any income statement that we need to build for you, and that's kind of what I was just addressing in the previous question there, which is okay. You can use whatever income statement you want. We're not interested in the granularity of the incomes or the detailed lines on the income statement, rather. We're obviously focused on profit because we want to know how much to close to retain earnings so that we know how much to balance our balance sheet by. And so that's what we focus on. The in-between income statement can be whatever it needs to be, and we'll use the same drivers that you saw on screen today. For the balance sheet, it is largely what it is. There are some configurations, as you saw with the funding, where you can tie out the funding accounts appropriately. Even on the debt schedule, you can actually tie out the debt accounts appropriately. The CapEx, you can tie out the CapEx appropriately. So there's the presentation version that you saw. That's largely fixed. But then there's the, how do I tie it into my model? How do I tie it into my financial statements? That you can configure at your heart's content. And if we need to, as part of the implementation effort, add 1 or 2 more accounts, we can absolutely do that. It's not a big deal.
Perfect. There's a couple of questions around the versions. So, one of the questions is, it looks good, but is there a specific version of OneStream that this is geared towards?
7.4. What was the earliest one with? Yeah, 7.4 is what I'm on right now. So I think that's most people are getting to 7.4 anyway. So I think you'll be fine on 7.4 and beyond.
Yeah. So I think if 7.4 would work with 7.3 as well, I would assume there, Vincent, you're probably thinking about workspaces and so on that's been brought in, but
yeah, workspaces.
Okay, so I think from that version onwards, then.
Yeah, you'll be fine. Yeah.
Perfect.
And an upgrade to those versions is also just hours of work. It's not a big deal. 8 upgrade is obviously a little bit more effort, but
hey, excellent. Thank you. Right, what am I going to do? I'm just going to share my screen back. So on the PowerPoint, let me get back there. So yep, so demonstration. Thanks for that, Vincent. Really appreciate your time in putting that together, and let's just move on. So I promised everyone at the start that I wouldn't go into a big old sales pitch beforehand, and I think I stuck by that, but it wouldn't be a webinar without some form of sales pitch at the end, more at the start. So what I'd say, it mentioned back at the start there with one of those questions, sorry, or at the start of one of the questions around how would we purchase a solution, contact us, get online onto the BDA website and contact us that way. And then there's a little bit here, just, so, why should you trust us? Going back to that conversation around, it's great having a strategic finance model, but I need to be able to trust that model. And to trust that model, you need to be able to trust the people that are implementing that and deploying it for you. So BDA, we are the largest global OneStream only partner. OneStream is the only thing that we do. As you can see here from on the screen, we are truly a global partner. These aren't that we just have projects over there. We actually have people all over the world employed by BDA. We don't use contractors or do any outsourcing. And we are recognized as, the leader in complex FP&A solutions, consolidations. We have a center of excellence, so really focusing on that industry and advisory expertise. And you can see some of the stats at the bottom there. We have done a significant number of projects. One of my favorite stats, I think down the bottom here, is around the number of projects, might be 150. There are fewer customers than we have than that, so organizations that we've implemented to. So one of the things that's not really called out here that I'm really proud of for us as an organization is that people will come back to us to do more projects. So it's not just a kind of one, we'll get something in, it went okay, but we're going to look somewhere else. We do repeat projects. We have people coming back to implement things like put the strategic planning suite in after we've done FP&A, or once we've done consolidation, we want to do some S&OP planning. So that's one of the things that I'm really proud of us for an organization, is that kind of retention and customer satisfaction that starts to drive some of those kind of stats. So at that point, then all I want to say is just thank you everyone for joining. Thank you, Vincent, for your time. Thanks everyone for your questions and paying attention throughout this. We really appreciate you joining this. The website's there on the screen for you. So if you did want any more information, please do get in contact with us, and we'll be more than happy to go into some of the additional details that you might want if you're interested in deploying this into your organization. Oh, I think I just saw one more question pop up. Sorry. Get right there at the end. Someone snuck in there at the end. So I saw there was some mapping to the balance sheet accounts, Vincent. But what is the mapping section associated with the income statements?
So because the income statement is built for your company, it doesn't matter. You don't need mapping there. We will build that as part of your implementation. And that's fairly quick because we can take whatever existing income statement you've got, talk about extensibility a little bit, and slam out an income statement in, a couple of days, 2 weeks, whatever it is. So whatever we need for the income statement, that's not a big deal. You don't need to map that at all. There'll be some
Perfect.
conversations back and forth about the level of detail like we spoke about before.
Perfect. Thank you, Vincent. And well done on sneaking that question in just before we close the call out. Right. Well, thanks everyone for your time. As I say, we really appreciate it. And hopefully we'll see you on the next webinar here with Black Diamond Advisory.